So Jeremy, let me start with you. Why don't you give us the background on what these tariffs are and why it's causing so much of a ruckus in the market?
Sure thing. I feel like it's one of those things where society is learning in real time about these things as they become very newsworthy, but we just try to keep it to the real key points here. So the first thing is just what is it? And I think that'll really flow through then to why it impacts markets. So a tariff, if you think of, you're a business in the United States, you import some of the goods that go into making your product, and you as the person importing those goods is paying this tariff, which I think really just effectively functions as a corporate tax. You can almost think about it that way. So if you're a business and you're looking at an increase in the cost of goods, you have really two choices. You can either increase your prices and pass some of that on to the consumer, or you can take a hit to your profit margin, or a little bit of both. And so when you're an investor in a company or a bunch of companies, like in an index fund, the thought is, well, you're purchasing a share of those future profits. That's what a share is. And if those profits are thought to potentially be lower because these taxes are essentially being paid and cutting into profit margins, you as the investor bear some of that loss. And that's what we're seeing as some of the volatility in the market. And that's certainly not the only thing. I mean, there's also this sort of just general sense of uncertainty. So you see this in a lot of individual markets where you say, well, should I be buying a car now or not? Like, should I be selling someone a car now or not? Is that the right price? What's the tariff going to be in the future? And so that type of uncertainty makes consumers and businesses a little bit more hesitant to spend or invest. And that also can drive down economic activity. So tariffs or large tax increases in general on companies are just generally not as good for profits, therefore not as good for short-term stock prices. But the very interesting thing about it is it's also a potentially a phenomenon that can go both ways. You even have seen this in the last couple of days where there will be news blurbs or news events that tariffs are softening or a new negotiation is being made, and it'll force the market up. And so it seems like it's really just people are trying to figure out, okay, what's really going to happen here? And so the volatility is likely to go both ways, and we don't really know when that's going to happen because it's subject to a lot of things that are outside of our control. So that's the very short term view. And then I think Eric, you'll place that in the context of a much longer term view of how markets work.
Yeah, and I think, in some ways I'm comforted a little
Mhm.
bit that it appears that this market correction is caused by the tariffs because that means it's really an event-driven correction, similar to, the COVID crash, which was very much like an event-driven correction. And as soon as that, event is kind of resolved, the market does tend to rebound from that pretty quickly. So we'll see. It's hard always to know if there's underlying kind of systemic issues beyond that. But yesterday it was really interesting. I know you saw this. A tweet. It turned out to be an erroneous tweet. Came out early, kind of early in the market session, and
Mhm.
said that the tariffs were going to be paused for 45 days. And literally on that tweet, the markets went up 7%, which
Mhm.
is incredible, right? Over that one potential piece of news. And so that does to me think, does reinforce that I think it's probably the tariffs, right, that are causing all this noise in the markets, but we will have to see.